Welcome. My name is Van Richards. I'm a chartered financial consultant, and I'm here to talk to you today about how that you can use retirement. You can use stocks for retirement to put together assets so that you can have enough money so that you never run out. I'll spit it out there in just a minute. But that's the whole idea of what we do in this show is we talk about the individual stocks. We actually pick apart two stocks from the NASDAQ 100 every day. And we talk about the earnings of those stocks. We talk about the competitiveness, and we talk about the stability of them. And then we discuss the suitability that they may have for particular types of retirement objectives. So without delaying too much further, let's go ahead and get into talking about the NASDAQ stock analysis. All right, the two stocks that we have to talk to you today about are going to be Texas Instruments, and we're also going to talk about TakeTwo Interactive software. Okay, we'll get all that out in just a few minutes. The idea is in talking about how to use stocks for retirement, we take a look at it from the standpoint of the earnings, the competitiveness, and the stability. Now, I want to bring up an article that was in the Wall Street Journal. Actually, it was an article it was on October the 8th, that was today, by Ann Tergeson of the Wall Street Journal. And the topic of the article was, should you retire early? Actually, let me read it to you. It says, should you consider early retirement in a recession? And really, my answer to that was it's actually in posing three different questions to you. And if you can answer these questions, then perhaps you are ready to retire, even if it is a recession. It might not make a difference, but you have to be able to answer these three different things. Number one is you have to ask yourself, am I mentally ready for retirement? Whether you are or not, it really depends upon where you are financially too. So that would be number two. You have to ask yourself, are you going to have enough money? And then number three, which I really think is a very, very important factor in putting aside money for retirement and planning for retirement is, how's your health? How's the health of your family members, those that live with you? If you have children that live with you, are you still supporting them in a way that you need to have more income coming in? How's the health of your spouse? How's your health? If you continue to work, how's that going to impact you financially going down the road? So answer those three particular questions. How's your health? Are you mentally ready? And do you have enough money? And if you can answer those three different questions, then perhaps you're ready to retire. And really the only way to arrive at a conclusion in all of this is you need to have a written plan. And that's really one of the things that I do for clients is I help them to devise a written plan. And I utilize actually a software package which guides us in the conversation. There's no software package that's going to basically be able to do everything. But I use a software package which is called Money Guide Pro. And it does an excellent job of looking at finances. We discuss your health. We also discuss your Social Security, your pensions, if you have pensions. If you have stock options, we discuss stock options and take a look at those also. But those are the three questions. And those have a big effect on how that you utilize stocks for retirement too. Now, if you are getting ready to retire or you're thinking of retiring down the road, now I know that we're going to talk about the two stocks that we have today, but in prepping and talking about that, you have to think of the mentality of, why am I going to be investing? I've had people that I've encountered before and I've talked to them and they've said to me, really, I don't need to invest. I've got a pension or I've got enough money saved up, whatever the case is going to be. I don't need to put my money at any risk. And if that's the case, that's quite all right. If you are at the point that you do need to invest, you're really the reason for investing in retirement, there's three different reasons. One's going to be diversification. And diversification has a big impact. In other words, you may have Social Security, you may have a pension, you may have bonds, you may have collectibles. You may have real estate. Stocks are a point of diversification. You don't want to have all your eggs in one basket. And we do that with stocks in itself too. You don't want to have all of your eggs in one basket with stocks as well. So that's why we talk about having a portfolio. The second reason that you use stocks for retirement is going to be dividends. And when we talk about Texas Instruments today, dividends are a really important factor. And the third reason that people invest in stocks for retirement is going to be growth. Now, you may have heard this, I guess it's kind of a rule of thumb that if you take your age and you subtract 60 from that, you take your age and actually you subtract it from 100. And if you're 60, that's what I'm trying to get at, then that particular rule of thumb would tell you that you need 60% in bonds and 40% in stocks. That always doesn't work out. You have to look at when you're going to use the money. If you're 60 and you're retiring, or you're in your early 60s and you're retiring, you may be focused also on having money available when you're 70 or when you're 80, when you're 90. It depends upon what your family health history is and what may be the possibility of how long that you might live. You may need 70 or 80 or even 90% of your portfolio put into stocks. That just depends on you. Or you may need zero. That just depends on your particular situation. So those are the three reasons that people utilize stocks for retirement. Okay, let's get into talking about pulling apart the two different stocks that we have to talk about today. The first stock that we're going to talk about is going to be Texas Instruments, and the second stock is going to be TakeTwo Interactive. So let's get right into it. I prepared a short little video that I know that you've probably heard of Texas Instruments. A lot of people have. One of the biggest reasons that people have heard of Texas Instruments, if you've been around for a little while, is going to be because of using calculators. Now, I use an HP calculator, but I remember many, many years ago when Texas Instruments was the pioneer in making financial calculators and scientific calculators. They were really the only company that was out there. They were really expensive. If you could think of spending $300 or $400 on a calculator in the 70s or the 80s, that was a lot of money. And before calculators, we used something like this. Do you know what this is? Some of you do, some of you don't. This is a slide rule. And that's actually one that I've had for many, 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 many years. I don't think you can buy those unless you buy them on eBay nowadays. But when I had calculus and algebra and trigonometry, we used a slide rule to begin with. That shows you how old I am. But hey, we started using calculators too. So the whole idea moved up. Okay, so let's get into talking a little bit more about Texas Instruments because they've moved far, far beyond using just calculators and manufacturing just calculators. So let's talk a little bit about that and take a look at what they do. Texas Instruments is the largest semiconductor manufacturer on the planet. And in looking at the video, you can see that they use it in automotive, in enterprise operations, in the Internet of Things. Automotive is really one of the things that I think that they've started to focus on a lot more, and it's been a healthy diversification in itself. The company's worth about $135.38 billion. They ended up today about 0.89%. The entire market was up, but they were up along with everything else that was out there today. If we take a look at this company from a year ago to kind of get an idea of what its history is, first off, we'll take a look at the return for 1 year. Then we want to take a little stroll back and look at a 5-year history too, because that helps us to understand how things are going and how they might be going as they go along. A year ago, they were trading at 121.36, and today they closed at 148.06. That's a pretty good increase, 22%. Now, it's nothing like Tesla that we looked at yesterday that's had over a 700% rate of return. But let's take a little bit further stroll back and look at what's happened over the past 5 years with this stock, because 5 years ago, the stock was trading only at 44.53 approximately on the 10th of October in 2015. And since that point in time, it has had a 232.5% increase. And let's get it where we are today. We ended up at 148.06, as we mentioned before. So the APR for Texas Instruments for the past 5 years has been stupendous. It's 26.16%. They've done awesome. Let's take a look at the earnings too, because the earnings has done their expectations. They've met their expectations every single quarter. We go back to 2015 and we look at this particular stock. Expectations have been soaring from that standpoint. Now, there's some discussion that we may be in a cyclical rotation. Now, what I mean by cyclical rotation is we may be moving into more of a value stock oriented market rather than a growth stock oriented market. Cyclical also has to do with Moore's law when we're talking about semiconductors. Moore's law basically says that the volume of a chip increases, it doubles every 2 years. So when we look at Moore's law, it's increasing too. But let's focus on cash flow with this company. Cash flow is doing really, really, really well. And that's one of the reasons why this company has an outstanding dividend. The EBITDA, the earnings before interest, taxes, depreciation, and amortization, has increased every single year. If you look at the chart, you can see it's going to go from the left actually to the right. And it's gone from 2019, 2018, it's increased. Actually, there was a little bit of a decrease in between 2018 and 2019, but it's still continued to increase, and they're in the black continually. Let's take a look at the positives and the negatives of Texas Instruments going forward. And this kind of gives you a little bit of an idea of, is this a time to invest in this particular stock, or is it a time to rotate out of it? One thing to consider is they are the largest chip maker in the world, and size matters when you're talking about chip makers. The way that their sales staff is developed is they do a great deal of cross-selling. In other words, if they're talking to a particular manufacturer about utilizing their chips for one thing, they have an opportunity to cross-sell into other avenues working with manufacturers. They also have a very good cash position. We'll talk about that too. Now, there are some negatives that are exposing Texas Instruments. They have intense competition. We're going to talk about the competition from some of the different companies like Analog Devices and Maximum Integrated, which are actually going to be merging here pretty soon. Well, it's proposed to merge. They have the cyclical vulnerability of Moore's law when they're not really producing and developing new chips. There's other companies that may be coming in to take over from that standpoint. The calculator business, it's possible that it could be declining. So those are some of the negatives when we look at it from that viewpoint. When we look at the forward dividend, this company has excellent dividends. It's 2.78%, and it's only forecast to get better because their cash position is excellent. If we take a look at how they compete, remember there's three things that we look at when we're looking at a stock. We want to look at the earnings, the competition, and the stability. When we look at the competition, this is just a spaghetti graph that we throw up here, and we look at Texas Instruments, Analog Devices, and Maxim Integrated. I'm also going to throw the next one up there, but it's going to also throw up also the size of the companies too automatically. Microchip Technology is included in there. Look, when you look at Analog Devices, which is really about the second size chip maker that's out there, it still, Texas Instruments dwarfs them. They're $135 billion. Analog Devices is 44.45. They're proposing a a merger between Analog Devices and Maxim Integrated. And if you look at the spaghetti graph, actually, you can see that Maxim Integrated stock price was probably the closest to that of Texas Instruments as we're going along after the pandemic. And recent months, it's really been exceeded over top of Texas Instruments. They've been a little bit of a laggard, but I think the size has something to do with that. Let's talk about sector rotation for just a moment. These companies are considered large core companies. Now, a large core company is going to be one that's based on value. In a few moments, we're going to talk about fair market value, and we're going to talk about actual value. This company is coming close to its fair market value, but it's still considered a growth company. The mid-core is going to be Maxim Integrated when they merge with Analog Devices. That's just going to make it even bigger, but they're still going to be smaller than Texas Instruments. But one of the problems that we can see right now with growth companies and with the communication industry is they're going to be impacted quite negatively by the proposed tax that's coming from let's say Biden administration, if there is a President Biden and a Vice President Harris that's out there. They're proposing to go from a 21% corporate tax to a 28% tax. This is actually, I want to share with you a study that was done by Bank of America Global Research. And this was actually in the Wall Street Journal on the 4th of October. And this particular study that they did showed that communication services, which would be Texas Instruments and Analog Devices and Maxim and Microchip Technology, all those companies will be those that are hit the most. And what I see by hit the most is their earnings will be reduced the most because of higher corporate income taxes. So if we go from a 21% corporate income tax to 28%, we could see that force these companies into a sector rotation. And what that means is that we could be going into value stocks more than we could be looking at growth stocks. And that has a big effect on how you should allocate your money going forward. Now, I'm not saying that it's Democrat or Republican. I'm not telling you which you should choose. I'm just telling you that this is how that financial policy of administrations can impact corporations. Now, we also talk about the moat of a company. Remember, this is a moat. A moat is that imaginary barrier that is in between a company and their competition. And that imaginary barrier that's out there is based on what they do. So let's take a look at this. The barrier right now, the biggest thing that Texas Instruments has going for it is the intangible assets that they have. They have a lot of proprietary designs. They also have a proprietary analog and their chip designs. That's a big benefit because these are things that other companies are not going to be able to develop because they have patents on them from that standpoint. Another thing to consider in what's going to prevent, let's say, a company from utilizing chips from Texas Instruments as opposed to Analog Devices or one of the other companies that's out there is going to be the switching cost. Switching cost basically means that if, let's say, for example, if you're an electric car manufacturer or any car manufacturer, because chips are used in just about all cars nowadays, and you are relying upon the accuracy and the risk, the tolerance of the chips in themselves so that they're extremely accurate. It has to do with everything from fuel consumption to if you have a self-driving car to the radar systems. If you have a self-driving car and you have a chip that fails, you could have a lot of problems from that standpoint. I think you can see what I mean. So manufacturers, and we're just using automotive as an example, manufacturers are hesitant to go to another type of chip from another manufacturer because there's always that unknown out there. It's just not that they have to learn how to integrate it into their system differently because of the proprietary characteristics. They have to understand that there may be some changes in the tolerances that are in the manufacturing the chips. And they don't want to do that as much. So that's considered a switching cost in itself too. Another thing is that Texas Instruments does have unique expertise that can't be duplicated. So that prohibits some companies there. And that's what creates that wide moat, that wide barrier in between Texas Instruments and their competition. One of the biggest advantages is the fact that they're the biggest. They're the largest chip maker in the world. And that makes a big difference from the standpoint of development also. They've got more money to put into research. They have more different types of chips. They have certain expertise that's been around forever. So this is why there's a wide moat with Texas Instruments. So let's take a look now and see what actually, we talked a minute ago about the fair market value of a company. The fair market value is calculated as a multiple of earnings. The type of earnings that's utilized, or actually the sales or another factor in there, is determined by the analyst. The analyst may look at it and say, hey, we're going to use this particular factor because this makes sense. So with Texas Instruments, we have a price at 148.06, and the fair market value that they've picked on this is 120. And that's not something that they just picked out of the sky and said, hey, this is going to be the fair market value. Remember, it is mathematically part of the calculation. Now there's a little bit of guesswork in there that goes when they start to look at, well, does this factor work better than this factor? And, I understand statistics from the standpoint that you might remember Samuel Clemens, Mark Twain. He said that when it comes to statistics, there are lies, and damn lies. So you can kind of twist this around sometimes. You have to look at the source of your information. I use Morningstar in this because Morningstar does an excellent job. They have analysts. They don't really have any bias that's out there, and they do a very good job of picking what I think is going to be the fair market value. Now, they also have a star rating that goes along with it too. Oh, before I forget, it's just the percentage of premium that it's trading at is trading at about 23% over top of the fair market value. And what Morningstar does is they look at companies that are under the fair market value, and they would give them more stars. If you're over top of it a lot, say, for example, like when we looked at Tesla yesterday, that was over 100% over top of the fair market value, they gave it 1 star. When we look at Texas Instruments, it's only about 23% over the fair market value of the stock. So they're going to give it 2 stars. All right, so let's look actually at what some of the analysts are saying. Now, this might surprise you. It actually surprised me. When we looked at what the analysts are saying about this, and these are different banks and financial institutions that we've polled, and there were actually 19 of them that specialize in the semiconductor business. And out of these 19 analysts, we saw that 11 of them said that this should be a hold. Only 5 of them picked it as a strong buy, and actually 3 analysts said that this is a strong sell. And that's kind of we've got 5 that are saying strong buy, 3 that are saying strong sell. So when we look at the averages, this is really what it comes out to be with this particular company. So this is where we're at. Yeah, amazingly enough, this is a hold. I was surprised. I thought it would be at least a moderate buy, but it wasn't. It's a hold. Okay, remember, this is just me reporting the analyst. I'm not telling you to go out there and buy and sell anything in particular. Okay, let's get into talking about the next company. If you are a fan of games, you have to have heard of Grand Theft Auto. I'll be honest with you and tell you that I've never played the game before, but it's extremely popular. Grand Theft Auto is extremely popular. The company that creates that is TakeTwo Interactive Software. They were down a little bit today, and there's a couple of things that are a headwind for TakeTwo Interactive. But one thing that they do have really going good for them is the fact that they've sold 220 million units of this game. That's pretty amazing. Now, that's not the only game that they have. They have NBA 2K, Civilization, Borderlands, BioShock, and XCOM. BioShock and XCOM are newer, and that's going to be significant too when we talk about some of the positives here in just a little bit. But let's go back and look at the performance of Take-Two Interactive Software over the past year. What we saw a year ago was at 74.48. Today it ended at 160.42. Hey, that's a pretty good rate of return for a whole year. They're up 115.39%. Now, if you follow the dancing cursor, this is actually where the height of the pandemic market crash was, but this stock was not fazed by the pandemic. That's because everybody was staying home playing video games, playing Grand Theft Auto because you're quarantined, or you're basically told that you have to stay home. So yeah, the quarantine actually drove this stock up. But let's take a look actually over the last couple of years too, because that kind of gives you a little bit better idea of how this stock has progressed. This is 5 years ago. 5 years ago, it was trading at $29.93. Of course, today it ended at 160.42. So what's that come out to as far as like a rate of return? Wow, 435.98%. I'd say that they've got a pretty good history that's going along there, because that's a 39.9% APR. Amazing. Look, I have to remind you, though, that the past performance is not going to be a guarantee of the future results of this stock. Now, there's no dividends, but I've heard that, growth is the new dividends. I don't agree with that, especially when we have things coming up like new taxes, possibly, that could impact it. We'll talk about that in just a minute. Let's take a look and see what they've done with earnings, because earnings has been up and down and up and down, but if you follow the guidance that's come from the company, the guidance has been pretty accurate. And they're actually saying right now that they're projecting that their earnings are going to be even higher. So that could drive the value of this stock up even more. If we take a look at how they compete with the companies that make games too, look, Take-Two is not the only company that's out there. If you follow games, you know that there's a lot more out there. Activision, Blizzard, Electronic Arts, Ubisoft. Now, when we take a look at these companies in themselves, the size of them does have an effect on the valuation going forward. Take-Two is $18.2 billion. It's what we consider a mid-growth company. And growth, remember that, because that's going to be important when we talk about sector rotation in just a little bit with this particular stock. When we compare it to Activision Blizzard, $60.12 billion, large core, they're not as much of a growth company. When we look at Electronic Arts, $30.4 billion, and Ubisoft, I was surprised, really. Ubisoft is really considered a mid-cap company. It's not as large as you might think. Now, when we talked about sector rotation, I showed you this slide just a little bit ago, and this is talking about the proposal from the Biden administration to go from a 21% corporate tax to a 28% corporate tax. You're going to have growth companies. Now, I know that Take-Two Interactive is not a communication company oriented like Texas Instruments, but growth companies are going to be more impacted as far as earnings go. I mentioned a moment ago that that the new dividend is considered growth. Well, that might change, because instead of just keeping earnings, companies may be passing those on, because when you pass earnings on to shareholders, guess what? The corporation doesn't have to pay the income tax. So a higher corporate tax could possibly spur more dividends. But also that has to do with how much income taxes that the whole company is paying. I think that they're actually going to be hurt a little bit by higher income tax. I don't know any financial person out there that would say that they're not. Now, when it comes to competing, remember, this is what a moat is. Remember, the moat of a company is that imaginary barrier that's between them and their competition. Now, the brand popularity is probably going to be one of the biggest advantages that Take-Two Interactive have. Hey, any of the companies out there, it doesn't matter whether it's Activision Blizzard or Ubisoft or EA, all of them have their own popular titles. Now, you know, in the gaming, electronic game world, let's say the stock world that goes along with games, it's not a winner take all situation. And I think that's really the next thing that I really want to talk about as far as a good thing that makes a narrow moat. It's not a winner take all situation with game companies and when trading stocks on them. The reason is because if you had, who out there has, if you are a gamer and you like games, who out there has just one game? Anybody? I'd venture to say that you probably have more than one game. Now you might have just one game system, you know, but as far as like actual games, you probably have different titles from different companies. So competition is going to be a healthy thing. A thing that could possibly hurt, and it makes the barrier between, you know, that competition a little bit more narrow, is going to be the relationship with Tencent. Tencent is the largest game maker in the world. It's a Chinese company. And even though that the four companies that I just talked about are primarily American companies, they have a lot of involvement with Chinese companies. They either have distribution arrangements or they have collaboration agreements with them. So if we have a White House administration that basically puts the kibosh on using Chinese companies, then that could hurt. So the relationship with WeChat and TikTok, if those types of things happen to Tencent, then that's going to hurt American companies. It's going to hurt Activision. It's going to hurt Take-Two Interactive. It's going to hurt Ubisoft. It's going to hurt a lot of them from that standpoint. So it doesn't really say that it's going to stop it, but it's not going to help it either. All right, let's look at the positives that are going on, because there are some positives that are going on with Take-Two Interactive. One is they have established game franchises. The Grand Theft Auto is significantly popular. They also have, you know, when I talked about XCOM and BioShock, those are new titles. So they're not just relying upon one particular title. The other thing is that they also have online games now, which allows the company to monetize their business. Now that's really important because, okay, let's say, for example, do you remember the Microsoft Windows? How many of you out there? A lot of you have Microsoft Windows. Now you used to pay for it annually, but then you went to an annual payment system. In other words, I remember buying a Microsoft Word and the Office, Microsoft Office, and I went out and I bought the whole program for about $400 or $500. But now you pay an annual fee. That is the way that the gaming world is working too, and it's heading that direction. And shareholders favor that a lot because it's a continuing income. So that makes a big benefit. So let's look at some of the negatives, though, that's going on right now with Take-Two Interactive. The negatives really are this. Number one, yeah, they had 220 million units sold of Grand Theft Auto, and they have continuing sequences that keep working, but that could possibly hinder in the future. It could hurt them. And the way that it could hurt them is if they rely upon one particular title too much. If it flops, then that could hurt revenues a lot. They don't have a lot of sports titles. That's a negative that goes along with it too. And the failure of the games, when we look at the size of Take-Two Interactive, it's not as big as a company like EA or a company like Activision Blizzard. Those companies, if they have one of their titles that fails, it doesn't hurt their bottom line as much. But if Take-Two Interactive has a sequel to Grand Theft Auto that fails, it's going to hurt the bottom line a lot more because they're a smaller company. So there's less water in the ocean for them. Okay, let's take a look and see what Morningstar says about Take-Two Interactive. The current value of the price of the shares today, as we saw, was $160.42, and they're actually pegging the fair market value at $148. And what that tells us is it's trading a little bit at a premium, not a lot. It's a little bit of a premium. And actually that garners 3 stars for Take-Two Interactive, which is actually a good thing. when we look at it from the standpoint of growth versus value, remember, if you're a value stock, you're probably going to get more of 4 or 5 stars. If you're a growth stock, let's say, for example, like a Tesla that trades at 100% over top of what the fair market value is, that's 1 star. But that doesn't mean that it's a bad company. Same thing. Look, Apple is a 1-star company, but that doesn't mean that it's bad. It means that they're trading more based on the growth anticipation than they are based on the actual value of the company. Now, this is kind of in between. When we say a core company, it doesn't mean that it's going to be a core company as the core of your investments. A core company is going to be a company that's going to be a cross between growth and value in that self. I actually call it GARP, G-A-R-P, growth at a reasonable price. I think that actually fits it a lot better than just calling it a core company. Okay, so we kind of get to the point of looking at also what the analysts are going to say about this particular stock. So let me make this just a little bit bigger so that you can see what's going on. Out of 19 analysts with TakeTwo Interactive Software, 14 of them are actually saying that it's going to be a strong buy. Nobody said that it was going to be a strong sell. So the average comes out to this as, yep, the average on this one is actually what I expected to be on Texas Instruments, but TakeTwo Interactive is a strong buy. Remember too that that's just what the analysts are saying. That's not me. Okay, as we come to this point, I just want to remind you that if you need some help in analyzing your stocks, if you need some help in determining which stocks are going to fit into your retirement plan better, go over to my website and arrange a time to talk to me. Now, I have to qualify this because I've had a few people that have contacted me from far off lands. I primarily do business in Texas, and I'm glad to share information with you no matter where you are in the world, whether you're in Bangladesh or whether you're in Italy or England or China, wherever you are. I'm glad to share information, but I can't do business with people other than those that are in Texas. So if you want to talk to me and get my opinion on how I could help you with your retirement plan, or just bounce some ideas off of me, I'll give you 20 minutes for free. Go to my website at richardsfinancialplanning.com. Go down to the button which says schedule a call to learn more. And there's a calendar that'll pop up. And when you go over and you hit that calendar, then the calendar gives you the opportunity to find a time so that you and I can have a phone conversation. If I need to see your documents or anything, we can do a Zoom call. That's really pretty easy to do from that standpoint. And I'm glad to do that. I'll give you 20 minutes for the first time for free. And then if we need an ongoing conversation, we can discuss that at that point in time. So we're getting close to the end of the week. We're getting close to the end of the NASDAQ 100. I've been doing 2 stocks every day for the past 2 months, and I'm getting close to getting to the 100. And we'll see what happens from that standpoint. So until tomorrow, thanks for listening today, and we will talk to you tomorrow. Make sure you subscribe.